Hello everyone, welcome to our discussion and demonstration having to do with capital budgeting, chapter 5 of our textbook. So chapter 4 was short-term decisions, and so we found that a lot of costs were not relevant because they don't change in the short term. They're not different based on these short-term decisions. In chapter 5, we're looking at long-term decisions. That means that there's going to be more things that are relevant because over the long term, everything can change, even fixed costs. But we still need to differentiate between those costs or those things that have to do with having to do with a particular asset or investment or project. So we refer to things in the capital budgeting when we're talking about long-term decisions as often a project, because we're talking about building or installing a large piece of equipment or some type of a building or something that's going to provide benefit over a significant amount of time. Because we're looking at this longer term, maybe 5 years, 10 years, even 20 years. Obviously, looking that far into the future makes it even more uncertain in terms of the amounts that we're going to use. We're going to have to make a lot of estimates, a lot of speculation as to what's going to happen, looking at various scenarios. So let's jump in and look at some of the principles that are going to guide us as we deal with this. So we're talking about assets just not this next year, but next several years. So the underlying idea in accounting between having to do with anything that's longer term is this concept that $1,000 today is not equal to $1,000 3 years from now. Now we all kind of intuitively understand this. We know that we would rather have the money today. We would rather be able to spend and go to the movies today than 3 years from now. That's just the way we work. That's just, and even businesses would rather have the benefit today than 3 years from now. So the concept makes sense. But we need to try to quantify just how much different, how much more do you want the money today versus 3 years from now. Now, in accounting, we basically have said that while it's still true, I'd rather have something now than 3 months from now, that difference is small enough that we aren't going to try to incorporated into the accounting. So we generally say that we're only dealing with it for 1 year or more, that we'll start to actually try to quantify. And really the concept of interest is that understanding. So if you have money, don't have the money today, if you postpone it 3 years from now, there is an opportunity cost. Remember chapter 4, we talked about opportunity costs. For not having that money now, you're giving up the interest you could have earned on that. So that's our first step towards kind of understanding how much we'd rather have money today versus 3 years from now or 5 years from now. And that is the idea of interest, because if you had it today, you could earn interest on it. So the higher the rate of interest that you could make on your money, the more, you would rather have it now. And the bigger that interest would be as a part of the equation. So if you think about how we apply interest, $1,000 in 3 years is the same as some lesser amount today. So let's say that we had $800 today, and we could use that to earn interest, and it would earn interest of $200 between now and 3 years from now. Then it would be $1,000, and we would be exactly the same spot 3 years from now. Either have $1,000, or we would have had $800 and earned $200 and still had the $1,000. Those would be the same. So we look at $800 as equivalent, or the present value of $1,000 3 years from now. That lesser amount for today, that with interest would get us to that amount in the future. That the term we use is present value. When we try to quantify just how much difference it is between what we have, what we want today and 3 years from now, we refer to it as present value. And so when we do a calculation called present value, and we'll show you a couple ways of doing that, we're taking out the interest part so that we can see just how much we need today, that if we add the interest back in will get us to $1,000 3 years from now. So that's what we do to apply present value. So when we do the math or the formula, we try to put this interest in. We need to remember that interest is added each period. So if you have $800 today, you earn interest for a year, and then you add that to the 800, and then you have that new amount that also now you're going to make interest on that whole amount. That's called compounding, and that needs to be considered. That's what makes the calculation of present value a little more challenging than just taking the difference between the two amounts. Okay? And there's a formula for doing that. And the way the formula works is we have a formula for future value. So if you had $800 today and you want to know what it would be in the future, that's a future value calculation. You add interest by multiplying by 1 plus the interest rate. So if you want to know how much your money's going to be if you earn 10% interest at the end of 1 year, you take the amount you have now, you multiply by 1 plus 10%, or 110%, and that'll give you the amount that you would have at the end of 1 year. And then you do that again for this end of the second year, and this again for the end of the third year. Present value wants to take out the interest, and so we divide by 1 plus the interest rate. So you see how important the interest rate is. It's determining just how much of that opportunity cost we're missing out on by waiting for our money later. Okay? So hopefully you see that the idea of buying an asset, a large asset that's going to last us 5 years, is the amount we're giving up now. Remember, it's valuable. We're giving the money up because we're buying the asset with the hope that the money we get in return because we have the asset in the future is going to be worth more than what we paid for it, right? And so we're going to look at those future payments and take out the interest, calculate their present value to compare it against what we're paying out, what we're giving up, our opportunity cost by paying for the asset. Because that money that we're buying the asset can't make us interest, right? It has to make us money by operating the new machinery of the new building. So, some smart individual said that formula is a little hard to remember, and we're gonna show you a demonstration of kind of how it works in our second half. But so they developed this present value table, And basically, it is applying that formula, that 1 plus the interest rate, either in dividing it to all these different possibilities. So this is how many time periods, and this is the interest rate. Those are the two pieces of information you need to know to calculate the present value. So if you want to know, take out the interest, and you're going to receive $1,000 5 years from now, and you could have made 3% interest, then to take out that interest, you would multiply it by this factor, 0.86261. That, by multiplying by that number that's less than 1, you're actually subtracting out the interest for those 5 years at 3%. And it's already calculated the fact that each year it's going to compound in this formula. So how do we apply that to an actual situation with an asset? We first of all have to identify the amount and timing of the cash flows, right? We have to say this asset is going to cost us this much cash flow right now to buy the asset, to get it set up, all that good stuff. And then we need to estimate, and it is an estimate, how much additional revenue, how much cost savings, whatever it's going to do. And we measure that in cash flows. How much more cash are we going to have flowing in because we bought that asset for the next 5, 6, 7 years, whatever the life expectancy of this asset is. So that process is important and has a lot of estimates. Then we need to establish the interest rate that we should use, right? We can't go to our tables, we can't calculate the present value until we put quantify the interest that we're giving up by buying that asset. So that's referred to as the required rate of return, this concept of interest rate, required rate of return. You'll see it used hurdle rate, cost of capital. There's several different terminology that businesses use, but it all comes down to what you're giving up, okay, in order to buy this asset. And so we'll apply the present value to each of the future cash flows, add them up, and compare it to what we have, what it's going to cost us right now, and that's going to tell us what the net present value is. The difference between the money we pay out now and the present value of those future cash flows is referred to as net present value. And we evaluate that by saying if it is positive, that we should do the project, meaning that the future cash flows are more than what we're giving up now. That's what we want to see. That means we got a good project. All right. If it is negative, meaning the amount that we pay out now is more than the present value of the future cash flows, then we should say no and shouldn't go forward with that project. So Excel can be used to do this very easily. Okay, and this is the formula at present value in Excel you can use. We'll show you how to demonstrate that in the second half. All right, but you're going to need to know the rate, and you're going to need to know the future cash flows are going to be put into values. All right. So the positive NPV indicates how much better off the firm will be with the investment. So it really is a measure of how much more profit we will have over time. Positive, go ahead. Negative, not to go ahead. You should not use NPV to rank alternatives. Just because one has an NPV of 10,000 and one has an NPV of 9,000, that one that's 10 is not necessarily better. This is simply a measure of should we do it or not. If it's positive, we should, okay, but it doesn't mean that if it's more positive, it's more better. Okay, that's poor English, but that gets you the idea. We also want to consider what we refer to as qualitative factors. There may be other reasons we want to go ahead with a project, even if it is slightly negative NPV. All right, and it might be that even if it's really close to zero, and of course if it's zero, we don't know what to do because there's not a decision made. We'd have to make the decision based on something else. In real life, when you're talking about spending millions of dollars, no business is going to do this with one scenario, one time. They're going to do lots of different possibilities. They're going to look at it and say, this is a worst case. This is what would happen if things fall apart. It doesn't work like we thought. This is what would happen if this is the most likely case. This is a best case where everything works perfectly. And look at what the NPV is for all the cases to see if even in like a worst case scenario, are we still okay or are we just barely negative? Now, there's a second concept that closely parallels NPV, and it's called internal rate of return. And its definition is specifically the percentage return on the investment that will provide and make NPV zero. So that means the value, the cost of our asset now is exactly the same, okay, as the future present value of the future cash flows. And remember, the future cash flow present value is determined by an interest rate. So in this scenario, what we're doing is changing the cash flows are the same. We're changing the interest rate until we get so that they're equal. And that's internal rate of return. That basically tells us how much we need to make those equal. If that return is higher than the required rate of return, that justifies going forward. That's a go signal. We can use IRR to rank alternatives. So that's its advantage over NPV is that it can show us which ones are better. You can use the present value tables with some guessing, but it's very tedious and difficult. So it's much easier in Excel, and you'll see that there's an IRR function where you identify the future cash flows. But in this case, instead of just the future cash flows, in NPV you only put in Excel the future cash flows and then subtract the present the amount of cash for now. IRR, you have to put all the cash flows, including the current amount you're going to pay out for the asset. We'll show you how that plays out exactly in Excel in part 2. So just to wrap up, when we are working on net present value or making these long-term decisions, we want to focus on cash flows, remembering that by necessity they are estimates, knowing that we could be wrong. And so when you're estimating, you're not going to estimate exactly, you're going to estimate kind of in round numbers, and that's going to need to be close enough to make our decision. Okay, but we're focusing on cash flow, how much money's going out or coming in. Qualitative factors like your reputation. We may do a project that doesn't have good NPV or because it will enhance our reputation, or we won't do something even though it's got a great NPV because it might hurt our reputation or might affect employees adversely or something else. Those are what's called qualitative factors. Okay? Of course, there's an ethical decision. Anytime that you're making estimates, there's a possibility that someone could interject their own view or their biased view on that so that they can get the result they want, a project that they have a particular interest in, make it look better, or that they might, and there's nothing wrong to be a champion and think a project is good, but when you start manipulating numbers in order to come up with the result, then you're starting to cross that ethical line and you're causing your company to make poor decisions. Okay? There's there may be times when you buy the machine now, but 3 years from now you're going to have to, you anticipate having to upgrade it. That would be a future cash outflow, and it needs to be considered in your model. You may have to increase inventory or other things to feed this machine, and therefore there may be additional what we call working capital. It is other stuff other than the machine, but necessary to get it to work. And when the machine is over, we might get that. We may be able to dispense of that inventory and bring that cash back in. So that might go out at the beginning and come back in at the end. Those are the kind of other considerations in our model. So now part 2, we'll go and actually dig into Excel, demonstrate this, and see if the practical hands-on will help you picture how this works and how we apply it in real life.